In today's session, we're going to talk about capital budgeting, which is essentially just long-term planning, and then talking about alternatives and approaches to deciding how to finance those long-term alternatives. At the end of our session today, we should be able to describe capital budgeting decisions and use the net present value method to make such decisions. The net present value method being the most widely used decision-making tool with respect to capital budgeting. We should be able to use sensitivity analysis to evaluate the changes or the effect of changes in predictions on investment decisions. We should be able to calculate the net present value difference between two projects using both the total project and differential approaches. We should also be able to identify relevant cash flows for use in these net present value analyses, and we should be able to compute the after-tax net present values of projects. We should also be able to explain the after-tax effect on cash received from the disposal of assets. We can use the payback model. We'll understand and work with the payback model and the accounting rate of return model and compare these with the net present value model as tools in the capital budgeting process. We'll want to be able to reconcile the conflict between using a net present value model for making decisions and using accounting income for evaluating the related performance. And then we'll talk a little about the impact of inflation on capital budgeting, which is covered in the appendix to Chapter 11. And so, as we said, the term capital budgeting describes the long-term planning for making and financing such outlays. Capital budgeting has three phases: identifying potential investments, choosing which alternatives investments to make, which includes gathering data to aid the decision, and then following up or monitoring to include a post-audit of our decisions and whether those investments are performing according to plan. So the most widely used capital budgeting model are discounted cash flow or DCF models. These models focus on a project's cash inflows and outflows while taking into account the time value of money. Discounted cash flow models are based on the theory of compound interest. And so essentially what we're saying is that we are discounting using discounting methodologies, discounting to present value dollars the value of this stream of payments that we're going to receive in the future. And this is a very important, one of the most important fundamental concepts in in finance. And so I want to be sure that you have a good grasp of what it means and then some of the calculation methodologies. So the net present value method computes the present value of all expected future cash flows using a minimum desired rate of return. The minimum desired rate of return depends on the risk of a proposed project. Obviously, the higher the risk, the higher the rate. This minimum rate, called the required rate of return, hurdle rate, or discount rate, and it goes by any one of those three names, is based on the cost of capital. So what the firm pays to acquire more capital. So essentially, if the firm has to pay 8% interest in order to borrow funds to invest in a capital alternative, then 8% may be the correct hurdle rate or discount rate or required rate of return. That 8% being the firm's cost of capital. So anyway, using this required rate, managers sum the present values of all expected future cash flows, that's inflows and outflows of any, from the project and subtract the initial investment. So to apply the net present value method, you can use the following three steps. Identify the amount and timing of relevant expected cash inflows and outflows. Find the present value of each expected inflow or outflow, and then sum the individual present values. So let's walk through an example. Managers at Toyota's Mississippi plant are contemplating the purchase of new, more efficient auto painting equipment that they expect will increase efficiency and produce operating savings of $2,000 cash per year. The useful life of the equipment is 4 years, after which it will have a net disposal value of 0. the equipment will cost $5,827 today, and the minimum desired rate of return is 10% per year. So this gives us the information we need now in order to calculate the net present value of these cash flows, and in this case it's the $2,000 cash inflow associated with the $5,827 investment in equipment, which has a useful life or is expected to last 4 years based on this minimum desired rate of return of 10%. And so when we look at the approach here that we're using, we take our $2,000 cash inflow, we apply a discount factor, which is in the first column of 0.9091 to year 1, 0.8264 to year 2. And these are all values that are out of tables. They're all algebraically calculated. You can use financial calculators to calculate them. But we're applying these factors to the flows at the end of each year. Out to the right we see of $2,000 at the end of year 1, again at the end of year 2, and 3, and 4, to come up with today's present value of these $2,000 in year 1 of $1,818. The flow from year 2 is worth today $1,653. The $2,000 cash inflow at the end of year 3 is worth today $1,503. And then finally, the $2,000 cash flow received at the end of year 4 is worth today $1,366. We sum the present value of each of those amounts to get to a current present value of these $2,000 annual cash inflows equal to $6,340. And we said that in order to make this investment, the equipment was going to cost us $5,827. And we have to pay that today. So the present value of that $5,827 is the current value. And so the difference between the present value of those future inflows of $6,300 and the $5,800 cash outflow is $513. And so in this scenario, we have a positive net present value, and our alternative would be to accept this alternative. Table B2 is an annuity table that provides discount factors for computing the present value of a series of equal cash flows at equal intervals. Because the 4 annual cash flows in our example are all equal, you can use Table B2 to make one present value computation instead of Table B1 to make 4 individual computations. Table B2 merely sums up the pertinent present value factors of Table B2. And so here you can see that we are essentially doing the same process that we did earlier. We're just saying that, well, instead of calculating the individual present values of each of the cash flows, because these cash flows are the same amount each year, it makes them an annuity, which is an equal series of payments over some period of time. So they constitute an annuity, and we can use a present value interest factor of an annuity, which we can again pull from the table. And you can see when we apply that to the $2,000, we get $6,340, which is exactly what we got in our earlier approach. We take the same difference between that and our initial outlay to come to the same present value amount of $513, and we accept this alternative because it's positive net present value. So we make 2 major assumptions when using the net present value model. First, we assume a world of certainty. That is, we act as if the predicted cash inflows and outflows are certain to occur at the time specified. Secondly, we assume perfect capital markets. That is, if we need to get extra cash or invest excess cash at any time, we can borrow or lend money at the same interest rate, which is our required rate of return. In a world that meets these assumptions, no model could possibly be better than the net present value model. Obviously, the world generally doesn't meet these major assumptions, but in order to reduce the complexity around the decision process, and again we kind of get back to that cost-benefit trade-off. How much effort do we want to put into the analysis? How much can we and do we need to simplify in order to get to some answer at some reasonable cost? So please be sure that you understand why the net present value method works, not just how to apply it. Managers determine the sum of the net present values of all expected cash flows from the project. The decision maker in our example cannot directly compare an immediate outflow of $5,827 with a series of future inflows of $2,000 each because of the time value of money. The NPV model aids comparison by expressing all amounts in today's monetary units, such as dollars, euros, or yen, at time zero. Therefore, at a required rate of return at 14%, the decision maker is indifferent between having $5,827 now or having a stream of 4 annual inflows of $2,000 each. If the interest rate were 16%, the decision maker would find the project unattractive because the net present value would be negative. And so another popular discounted cash flow model is the internal rate of return model. This model determines the interest rate at which the net present value equals zero. If this rate, which is called the internal rate of return, is greater than the required rate of return, the project is desirable. If not, it is undesirable. And so essentially, again, what we're saying is that going through an iterative process, and financial calculators will do this, and we have formulas that will also do this. It can also be done in Excel, just like the net present value models. And what we're saying is that the internal rate of return is that point, that interest rate, at which, in our example, that $5,827 of initial outlay is exactly equal to $5,827 of net present value of future cash inflows. And that gives us what our internal rate of return is. And we can see here in the middle block is so that if the internal rate of return is greater than the minimum desired rate of return, then the net present value is greater than zero and we accept the project. If the internal rate of return is less than the minimum desired rate of return, then the net present value is less than zero or negative, and so we reject the project. And so again, internal rate of return is just another model, just another way, like the net present value model, that we use to base capital investment decisions between alternative investment options on. A real options model recognizes the value of contingent investments, that is, investments that a company can adjust as it learns more about their potential for success. And so because the future is uncertainty, actual cash inflows may be different or may differ from what was expected or predicted. To quantify this uncertainty, managers often use sensitivity analysis, which shows the financial consequences that would occur if actual cash inflows and outflows differ from those expected. It can answer what-if questions like what will happen if the net present value, or to the net present value, if my predictions based on useful life or cash flows change. And so let's talk about a sensitivity analysis example. Suppose that the manager knows the actual cash inflows in the previous example could fall below the predicted level of $2,000. How far below $2,000 must the actual cash inflow drop before the net present value becomes negative? And we would use sensitivity analysis to answer that question. And so let's suppose the Toyota managers know that the actual cash savings in Exhibit 11-1 could fall below the predicted level of $2,000. And so again, we're asking how far below $2,000 must the annual cash savings drop before the net present value becomes negative? The cash inflow at the point where net present value equals zero is the break-even cash flow, right? We've recovered all of our investment, but we've not recovered anything additional. So it's not a positive net present value, it's not a negative net present value, it's zero. So if the annual cash savings is less than $1,838, the net present value is negative and the managers should reject the project. Therefore, annual cash savings can drop only $2,000 minus the $1,838 or 162% or 8.1% below the predicted amount before the managers would change their decision. And we got to that amount by simply dividing the cash, the initial cash outflow or required investment of $5,827, we divided that by the present value interest factor of the annuity to get $1,838. So in practice, managers very rarely look only at one project or option at a time. Instead, managers compare several options to see which is the best or most profitable. We will now see how to use net present value to compare two or more alternatives. Two common methods for comparing alternatives are the total project approach and the differential approach. The total project approach computes the total impact on cash flows for each alternative and then converts these total cash flows to their present values. It's the most popular approach, and we can use it for any number of alternatives. The alternative with the largest net present value of total cash inflows is best. And often what we see is that a company will have multiple alternatives, each with their own different cash net present value, and each with their own different initial investment requirement, and so a company will tier these from highest net present value to lowest net present value to determine which alternatives are most attractive given the level of investment capital that they have. The differential approach computes the differences in cash flows based between alternatives and then converts these differences to their present value. Remember, we cannot use this method to compare more than two alternatives. Often the two alternatives being compared are invest in a project or do nothing. When you array the relevant cash flows, be sure to consider three types of inflows and outflows. Initial cash inflows and outflows at time zero, future disposal values, which become cash inflows at some point downstream when you get rid of the equipment, if there's any salvage value left, which then needs to be discounted back, and operating cash inflows and outflows. And so the major purpose of most investments is to affect operating cash inflows and outflows. Many of these effects are difficult to measure, and 3 points deserve special attention. The only relevant cash flows are those that will differ among alternatives. Often fixed overhead will be the same under all the available alternatives. If so, you can safely ignore it. In practice, it's not easy to identify exactly which costs will differ among alternatives. Remember that you are predicting cash inflows and outflows, not revenues and expenses. Therefore, you should ignore depreciation and book values. We recognize the cost of assets by the initial outlay, not by depreciation as computed under accrual accounting. Further, cash inflows may not occur in the same period as the related revenues, and cash outflows may not coincide with the related expense recognition. Finally, we treat a reduction in the cash outflow the same as a cash inflow. Both signify increases in value. And so many capital budgeting decisions compare a potential investment with doing nothing. One such decision is investment in a highly automated production system to replace a traditional system. Cash flows predicted for the automated system should be compared with those predicted for continuation of the present system into the future. The latter predictions are not necessarily the current cash flows because the competitive environment is changing. If others invest in automated systems, failure to invest may cause a decline in sales and an uncompetitive cost structure. The future without an automated system might be a continual decline in cash flows. And so we must consider another type of cash flow when making capital budgeting decisions, and that is income taxes. Income taxes paid by companies are cash outflows. Their basic role in capital budgeting does not differ from that of any other cash outflow. However, taxes tend to narrow the cash differences between projects. In capital budgeting, the relevant tax rate is the marginal income tax rate, that is, the incremental taxable income. The cash flow before considering the effect of income taxes is called pre-tax cash flow, and the amount after the effect of taxes is the after-tax cash flow. All of our previous examples in this chapter have ignored the effect of taxes, so the cash flows discussed have been pre-tax cash flows. One item that often differs between tax reporting and public reporting is depreciation. Recall that depreciation spreads the cost of an asset over its useful life. Income tax laws and regulations generally permit companies to spread the cost over depreciable lives that are shorter than the asset's useful lives. Organizations that pay income taxes generally keep two sets of books, one set that follows the rules for financial reporting and one set that follows the tax rules. This practice is not illegal or immoral, it is necessary. Tax reporting rules are designed to achieve certain social goals. These rules are in many instances different from the financial reporting rules designed to best measure an organization's financial results and position. We also note here that U.S. tax authorities also allow for accelerated depreciation, or what we call MACRS, Modified Accelerated Cost Recovery, which charges a larger proportion of an asset's cost to the earlier years and less to later years. In contrast, an asset's depreciation for publicly reporting purposes is usually the same each year, which we call straight line depreciation. And so, again, it's important to remember that depreciation really has nothing to do with the depreciation method, and depreciation itself has really nothing to do with the cash flows that we use when calculating net present value or internal rate of return, or the cash flows associated with the project. However, the impact of the depreciation method on the taxable income, and thus the cash required or cash saved with respect to taxes, does become something we include in our analysis. So, for example, note that we computed the net cash effects of operations in Exhibit 11-4 by multiplying the pre-tax amounts by 1 minus the tax rate, or 1 minus 0.4 equaling 0.6. The total effect is the cash flow itself less the tax effect. Each additional dollar of sales also adds 40 cents of taxes, leaving a net cash inflow of 60 cents. Each additional dollar of cash expense reduces taxes by 40 cents, leaving a net cash outflow of 60 cents. Thus, the after-tax effect of the $130,000 minus $70,000 is equal to $60,000 net cash inflow from operations, is an after-tax inflow of $130,000 times 0.6 minus $70,000 times 0.6, or $36,000. In contrast, we compute the after-tax effects of depreciation by multiplying the tax deduction of $25,000 by the tax rate itself, or $25,000 times 0.4, which is equal to $10,000. Note that this cash inflow, because it is a decrease in the tax payment. Without the depreciation deduction, taxes would be higher by $10,000 annually. The total cash effect of depreciation is only the tax savings effect. The depreciation deduction reduces taxes and thereby increases cash flows by $10,000 annually. So governments frequently allow accelerated depreciation to encourage investments in long-lived assets. Under the U.S. income tax laws, companies depreciate most assets using the Modified Accelerated Cost Recovery System, or MACRS, and we talked about that briefly a few minutes ago. This system specifies a recovery period and an accelerated depreciation schedule for all types of assets. The MACRS system places each asset in one of 8 classes. And so when we talk about this, the MACRS, it specifies the timing of deductions for each recovery period. The present value of the depreciation tax shield for any recovery period can be easily computed. So again, we're talking about, well, so using MACRS and the fact that we're able to recover a greater percentage of the cost of the asset through depreciation impacts our taxable income, which impacts the amount of tax we pay, creating a cash inflow which we then need to discount to present values. This versus the straight line method that doesn't allow for this greater, earlier cost recovery and doesn't give us the same impact on taxable income, so we don't have the same net present value calculations to make. So the disposal of equipment for cash can also affect income taxes. Suppose Toyota sells its $125,000 machine at the end of year 3 after taking 3 years of straight-line depreciation. So we see that the depreciation was calculated, was $25,000 a year. It's a 5-year piece of equipment purchased for $125,000. 5 years calculated on a straight line basis, 125,000 divided by 5, it gives us a straight line depreciation of $25,000 per year. So we know that the book value then, that is the net book value, the cost minus the depreciation or accumulated depreciation taken through the end of 3 years, is $50,000, or $125,000 minus the $25,000 taken each year. So we have a $50,000 net book value. So if Toyota sells this piece of equipment for its net book value of $50,000, we have no tax effect, right? It was worth $50,000 on their books and it was sold for $50,000, so there's no gain or loss. If Toyota receives more than $50,000, there is a gain and an additional tax payment. If they receive less than $50,000, there is a loss and a tax savings, and it's this tax effect, either the tax payment or the tax savings, that we factor into our cash flows for that year, that we then also would discount back to current period in getting to the net present value, or if we use the internal rate of return, getting to what the internal rate of return would be. And so here we can see we have another example that the suppose that the cash proceeds of the sale are $70,000 or $20,000, right? Assume the equipment is sold for $70,000 and the tax rate is 40%. What is the tax savings on the sale? So the cash, the gain is $20,000. It's the $70,000 we received for it minus the $50,000 book value. So there's a $20,000 gain. If we assume that the tax rate is 40%, we have an $8,000 sale, right? We have an $8,000 gain. The net cash inflow from the sale then becomes $62,000 because we have to take our $70,000 minus the $8,000 that we are going to have to pay in taxes to get a $62,000 cash inflow. So there are other related inputs to the replacement decisions. For example, the cost of new equipment, the tax effect of depreciation on the new equipment, and the differences in future annual cash flow from operations. We also have other models for analyzing long-range decisions. One example of this is this payback period or payback time, and that's the time it will take to recoup in the form of cash inflows from operations the initial dollars invested in the project. Assume that Toyota spends $12,000 for a forklift that has an estimated useful life of 4 years. So we make those assumptions, right, that they spend $12,000 for a piece of equipment and has an estimated useful life of 4 years. Based on that, we have an annual savings is expected of $4,000. What is the payback period? And the payback period is simply the initial investment divided by the amount of the annual cash inflows resulting from the investment. In this case, $4,000. So the payback period is 3 years. And so with respect to the payback period, we also want to keep in mind that that ignores the time value of money. It ignores the fact that we may receive cash inflows beyond the payback period. But the advantages of it is that it's very easy to understand. It's generally used in very simple situations by smaller organizations, and so there is a cost-benefit advantage to it. The accounting rate of return model expresses a project's return as the increase in expected average annual operating income divided by the initial required investment. The average annual incremental cash inflow from operations minus an incremental average annual depreciation, which is how we define operating income. So operating income is average annual incremental cash inflow from operations minus the incremental average annual depreciation. And so that divided by the initial required investment gives us the accounting rate of return. Again, we notice that this ignores the time value of money. So to see how the accounting rate of return works, let's assume an investment of $5,827 with a useful life of 4 years. We estimate that the disposal value is 0 and the expected annual cash inflow from operations is $2,000. The same example we worked with when we were calculating net present value. So annual depreciation is $1,456, which we calculate as $5,827 minus any disposal cost, and we are told that there are none, divided by the useful life. We substitute these values in the accounting rate of return equation. And when we do that, we get the accounting rate of return equal to $2,000, the annual cash inflow minus the $1,457, divided by the $5,827 amount dollars of initial required investment to get us an accounting rate of return of 9.3%. And so what we're saying is that, well, if their cost of capital is less than 9.3%, we would accept this alternative and invest. If the cost of capital is greater than 9.3%, using the accounting rate of return, we would see that we are not going to get a return as great as what it's going to cost us for the capital used to invest in that return, and so we would reject the alternative. So some companies use the average investment, often assumed to be the average book value over the useful life, instead of the original investment in the denominator. The investment committed to the project would decline at a rate of $4,056.75 per year from $5,827 because of depreciation. Hence, the average investment would be the beginning balance plus the ending balance divided by 2, or $2,913. Obviously, if we work through the same accounting rate of return formula as the average incremental annual incremental cash inflow minus the incremental annual depreciation divided by this average investment, we get a return of 18.6%. And so, again, it's the difference between what do we use in the denominator of the equation. So now let's talk about performance evaluations. Many managers who evaluate on the basis of accounting income or an accounting rate of return model are reluctant to accept discounted cash flow models as the best way to make capital budgeting decisions. Many managers would be reluctant to replace equipment despite a positive net present value if superiors evaluated their performance by accounting rate of return. So the best way to reconcile any potential conflict between capital budgeting and performance evaluation is to use discounted cash flow for both capital budgeting decisions and performance evaluations. Companies that use economic value added, or EVA, for performance evaluation avoid some of the conflict. Although EVA has a weakness of using accrual accounting measures of profit and investment rather than cash flows, it has conceptual similarities to the net present value method of capital budgeting. Both EVA and NPV recognize that a firm creates value only after projects cover their cost of capital. And so another way to address this issue is to conduct a follow-up evaluation of capital budgeting decisions, often called a post-audit. And so now we want to talk about a few of the purposes of a post-audit. The purposes include seeing what investment expenditures are proceeding on time and within budget. The purpose could be to compare actual cash flows with those originally predicted in order to motivate careful and honest predictions. Or a purpose could be to provide information for improving future predictions of cash flows. And another purpose may be to evaluate the continuation of the project. And so we see that there are several purposes of a post-audit, but it's always good to look at these investment decisions and to understand whether we're on track with meeting our expectations or not, well before the end of the project. So inflation is defined as the decline in the general purchasing power of the monetary unit. The key to appropriate consideration of inflation in capital budgeting is consistent treatment of the required rate of return and the predicted cash inflows and outflows. To this end, we can achieve such consistencies by including an element for inflation in both the required rate and in the cash flow predictions. Many firms base their required rate of return on the market interest rates, also called nominal rates, that include an inflation element. And so this concludes this chapter 11, where we talk about capital budgeting. And again, capital budgeting is an important process for many organizations, or most organizations. It provides us with models and ways of determining between alternatives what are the best, apparently most advantageous alternatives for the organization to select from. And then it provides us with a way of understanding whether or not these alternatives were meeting expectations or not. So please read the chapter carefully and closely, particularly with respect to net present value, which is really a foundational concept in finance. And to make sure you're comfortable with it. You'll cover it in much more detail in later classes, but it's good to have a strong underlying foundation of it as you go into these other classes. And then if you proceed to the learning exercises and the discussion forums. So thanks very much for your time.